Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 20 minutes, we'll talk about a particular aspect of mutual funds. And this is very important for people who are wanting a bit of safety in the current market scenario. Because if you look at equity savings funds, the category which was literally shunned in 2022, came back with a bit of mojo in 2023, delivered about 14% returns. So is it good as a scheme for regular income seekers who are also maybe a bit risk averse but want equity taxation? I think that's the topic that we should try and tackle today. And just the right person to talk about that, or maybe many other topics, Swaroop Mohanti, Vice Chairman and CEO at Mirae Asset Investment Managers India, joining us on the show. Swaroop, thank you so much for taking the time out. Always good talking to you.
Thank you so much for having me on the show, and especially about this product. I'm so happy we are discussing this product.
Yeah. So tell us, Swaroop, I mean, in some sense, after the lackadaisical 2022, this product came back in vogue in 2023. Tell us, how do you think about equity savings as a product per se, firstly?
See, Neeraj, first of all, when you look at the risk profile of the entire country, and I'm quoting the RBI data, nearly 55% of a person's money is in the bank and bank-related products. So that's the risk profile. But when you look at this profile, this product is perched there in that risk profile. But unfortunately, people look at other aspects rather than the merit of the product while investing. That's why probably this has been a more on and off product than what the merit of the product sort of justifies. It should have had larger share within investors, and it demands that merit to have a larger share in what you rightfully put, a person who is looking at less risk or a downside protection, at the same time wants a little more addition to the returns over the debt products that they have.
Okay. I'm guessing that returns on this category are not necessarily predictable based on past returns, but is there an average kind of expectation that a person should keep from this category, part one? And does this, part two of my question, is this a scheme or is this a set of funds that are more amenable with the markets at a particular level versus less amenable when the markets are in a particular kind of trajectory? Is there some bifurcation to do that way?
See, actually, when you look at progressing from pure debt to any form of equity, rightfully so, the person should be awarded on the risk-adjusted return. So when one takes that journey, one is necessarily looking for slightly above the debt returns, which is fair from an investor perspective. Secondly, due to the taxation advantage of this product, the post-tax returns can be definitely better than what can be expected from a debt product. That's the advantage that it carries. But from the basic construct of the product, it is done in such a way that it does accommodate market changes, and the equity portion of the portfolio then changes accordingly. I mean, when the fund manager feels the market is high, tries to get back the pure equity portion and balances it out of arbitrage. And we've seen the industry moving from as low as 15% in equity to as high as 45% on an average, just showing the dynamism that the fund manager brings to the table when managing the equity of this product. And inherently, since this product is meant for risk-averse people, broadly the industry is tilted towards large cap on the equity portion of this product. So prima facie, when you look at it from a risk-adjusted and post-tax return, I would definitely look at a slightly higher debt plus return. I would call it a debt plus category rather than a pure equity category.
Okay. Yeah, but which is what, and this plate is important, viewers, because someone I'd love to understand, how is it that returns have been so choppy and volatile? And I'm taking a very short time window, but 2022 returns 4-5%, maybe slightly more than that, single digit. Suddenly 2023, 14% returns. Why is that happening, and what is the kind of expectations that a person should realistically keep, keeping in mind that you said that it is a debt plus offering?
See, I think the right way of always approaching is comparing to the debt returns that one is getting in the market.
Okay.
When you look at that period simultaneously, the debt returns were not as high as they are today. So typically when one progresses, I as an investor would look at it as debt plus 1 or 2% from my return expectation is how I look at it. But then when you take that as a positioning, the fund manager then has that mandate of moving out in and out of equity within that region to generate that return. It is wrong to compare these products to fully equity products, and hence the return has to be in line of that expectation. So if I were to look at this product, then I would look at it slightly higher than debt for sure, number one, and the tax advantage you cannot take away from the product.
So again, for somebody, I'm just trying to play the devil's advocate, but for somebody who is risk averse, but open, or largely risk averse, let's say, but open to take a little bit of risk, this far outstrips the kind of returns and the taxation that would be eligible, that a debt fund investor would be eligible for any which ways. Would that be a fair way to look at it?
Absolutely, that's the right way of looking at it. You at the same time, you rely on the fund manager to look at the downside protection of the risk in balancing between equity and the arbitrage, and definitely but the key is holding it over a period of time. I mean, there would be times when the equity markets would go through the period, and hence the returns can be lower when you broaden the horizon to 3 to 5 years. And typically, all investors look at longer horizons. The problem is their horizon is long, but the investment vehicle is always remaining short. Once you start matching your investment horizon to your investment, to your longevity of your requirement, the desired results can come. When you project that same return over 3-5 years, you will see a good average return of debt plus emerging. And that's how investors should approach it, and not be carried away by short-term ups and downs of any product in the market.
Okay, all right, viewers, remember the AUM trajectory of these funds from March 2023, 16,000 crores to Feb 24, about 28,000 crores. So clearly, there has been flocking of investor capital into some of these into schemes in this category, and kind of shows the effectiveness as well. I was seeing some data from the house of Mirae when it comes to these schemes, Swaroop, and it kind of shows that at different points of time, or at different levels of the Nifty, or maybe at different valuations. Valuations could be the starting point, and the time and the levels might be incidental to that. But you've brought down your equity exposure into these schemes as well. Is there a reason behind? I mean, are you guys skeptical about the kind of returns that equities can give, or is it because the product is suited for more risk-averse investors?
Yeah, first of all, you have to always keep the risk profile of the investor in mind. That is this product. So hence two things happen. As per the valuation and the level mark of the market, the fund manager kind of brings down the equity level. At the same time, the composition of equity has to be more or less tilted towards large cap. These are two inherent given of this product, and that's how it has to work within that risk profile that it caters to. We kind of have shifted not much when it compares to the market. We are known for being a fully invested fund, and we don't take much cash calls as we speak in our broad portfolios. But the composition of the stocks would change dramatically as the markets change. But broadly, there are other funds which swing on equity allocation. Sometimes they come down to 14-15% and go up to 40-43%. So one should always consult a good advisor in choosing such a fund, and choose one which suits their risk profile. That would be a genuine advice.
Okay. Swaroop, final question really, and which is, I mean, there's a lot of talk, warning, etc. being given around what's happening at the broader end of the spectrum. I would love to understand your perspective here. This is off topic, viewers, but it is important because when we get Swaroop Mohanti, we should try and get those views as well. What is your own view around the SMID space?
See, Neeraj, finally it's the marketplace, and marketplace, a price is run by demand and supply. At this moment, there is enough money in the market to take the prices up. Now, in that scenario, I always say that, you have to invest as per your risk profile and your asset allocation. If you keep looking at markets, then you'll more or less behave in a very, very fluctuating manner, and that will do a lot of harm to your inherent longevity of your portfolio. And invariably, you lose out the beauty of compounding effect in your portfolios. In such scenarios, you should then rebalance your debt side of the market. Don't get carried away by markets. Markets always will see such cycles. Either you rely on a good distributor advisor, or you rely on a good fund manager if you are not finding answers. But don't look at markets. India, in the next 10 years, will see a good run in the markets. Focus on the larger picture. I always ask people Are you looking at India at 7 trillion, or are you looking at the Sensex at 70 or 1,000? It depends on how you look, will you behave. I mean, when you know this country is going towards 6 or 7 trillion, what should be your approach? So these short-term blips in the market should not impact the thought process of investing. Stay invested in this market. It's only when you stay invested for a longer time that you benefit this growth story of India. And the best way of benefiting this growth story of India is through the capital markets. But stick to your risk profile is my final sort of submission.
Yeah, in some sense, don't miss the forest for the trees, if you will.
Absolutely.
Swaroop, Mohanti, such a pleasure talking to you. Thanks for taking the time out and being with us on the show today.
Thank you so much for having me, Neeraj.
The pleasure is ours. Well, viewers, we were talking about equity savings as a category. We're joined by Prableen Bajpai, founder of FinFix Research and Analytics. Prableen, great having you as always. Thanks for joining in. Can I start off with understanding from you whether you believe it's a good category to invest in and for what kind of investors? Because it's certainly seen significant uptick in inflows or AUM in the last 12 months. So who should subscribe to this category? What funds within the equity savings space do you like and why?
Good afternoon, Neeraj. Absolutely. Almost, I think, 10 to 11,000 crores of additional AUM that we've seen in the last 1 year. And that is primarily because of the taxation change that we saw in the Union Budget of 2023. Having said that, I think equity saving schemes is a great category for those investors who can have some exposure to equity and they understand that there would be downsides to it as well. Have a horizon of say 2 to 4 years. So they don't want to go all out into equity. And if you're staying in debt or fixed income, it's not very lucrative post-tax. So for a person who's in the higher tax slab, has this sort of a time horizon of 2 to 4 years, 2 to 3 years, and can understand equity, I think it's a great category to be in. And the returns, of course, what we've seen across the category over the 10-year period, if we look at the rolling returns, which they've averaged about 8.5 to 10% on 2-year, 3-year, and 1-year rolling return basis over a 10-year time period. So broadly, I think, from with the post-tax return that we can get from this category, it's a good, it can be a good addition, but like I was listening to Swaroop, he said that, the objective has to be very clear when you're investing. If you do have that kind of a goal in mind, where you need to park money, yes, this category can be considered. And within this category, some of the funds, I would go with the more credible names who can manage equity and the debt component very well as well, because a decent part is in debt as well. So arbitrage, equity, and debt, it's a combination of the three. So, for example, ICICI, they're slightly conservative. They're currently holding about 15% in equity. We have fund houses like SBI, Mirae, HDFC. I think these are the credible names to go with.
Okay. Prableen, thanks for that advice. Now, there are people who've sent in some queries. Prableen, I'd love for you to try and help some of our viewers who've asked this. So the first query is coming in from Rahul. His age is 21 years. He's saying that he wants to create a retirement fund, I presume, because he's invested about 15,000 through SIP in ICICI Prudential Nifty 50, 5,000 in Quant PSU thematic as lump sum, wants to retire by 40 years, when he's 40 years old, and accumulate a retirement corpus of 5 crores. Now, his question is, what funds should he invest in? I presume the other question should simultaneously also be, what kind of money should he invest into some of these funds? Probably any thoughts here?
Right. So first, I'll just break down the SIP allocations which are there for him. So Rahul is currently investing a big sum of 15,000 into the index fund, which is a great start. And then he has 5,000 in the quant thematic fund, the PSU segment. So I would recommend that if he has to invest this 20, he can diversify that 15 into 2 other schemes. One would be the mid cap index and one would be a small cap fund. So the overall 20,000 will be 5,000 each into the large cap index, the mid cap index, active small cap fund, and the thematic fund. With this 20,000, Neeraj, in the time period that he has mentioned, if we are assuming 12% XIRR, which is, I think, on the conservative side, he can create about 1.6 crores in the next 19 years. And if he's able to do a 10% step up, so if he can incrementally increase his investments by 10% each year, he can create a corpus of more than 3 crores, about 3.2, 3.25. But having said that, Neeraj, if he's looking to sort of take early retirement or probably retire from active work life and start something of his own, it would be really essential that he has the money to sustain himself at that time period. So the actual requirement of the corpus must be dependent on the kind of expenses that he's going to have over a period of time. And this 5 crore, if we sort of discount with the inflation, it would be equivalent to roughly 1.6 crores of today. So that is something that he must factor in.
Okay, so just to make it clear, what's the quantum of money that you, Prableen, do you believe he will have to put in every month additionally?
So overall, he has to put about 60,000 a month to achieve that corpus of about 5 crores.
Got it. I hope, Rahul, you got that, because money doesn't grow on trees, return doesn't come just like that. You got to put money to work. That's the first advice from Prableen. Very quickly, Prableen, the second query is from Prasanna. Prasanna is age 29 years. He's preparing for children's education, and he says that his wife and he buy 1 gram of gold every month as an investment. He deposits 3,000 per month at an annual interest of 9.85 in a cooperative bank, and wants to invest about 5,000 per month in mutual funds. What kind of funds would you recommend? Sorry, probably I can't offer you his risk profile, but he doesn't seem to be wanting to know what quantum of money, but he seems to be wanting to know how does he invest 5,000 within the mutual fund arena.
Right. First of all, Neeraj, I love this idea of 1 gram of gold. I'm going to suggest this to my husband that please buy me this 1 gram. This is really interesting. Having said that, you don't actually allocate physical gold towards goals. So that has to be understood. So whatever they are buying would probably be used for the marriage of the child instead of education, because I don't think that they would go out and sell physical gold. Coming to his goal, so education inflation in India is around 10 to 12% the inflation, and which is a very high ask period. So if you're investing in any fixed income product, your real returns to achieve your education goal are actually in negative. But if he is wanting to go with this 5,000, and if we are assuming 12% XIRR, he would be able to gather about 24 lakhs in the next 15 years. Again, with a small increment, 10% STP, he can gather about 42 lakhs. I would really recommend that 15 lakh college fee of today would be about 65 lakhs if you're assuming roughly 10.5, 11% inflation. So he must increase his allocation towards equities, and maybe the 1 gram gold can actually be reduced to a little lesser, and say about 8,000 can be allocated towards the SIP. Then he can generate with a 10% step up a 66 lakh corpus in 15 years. I'm assuming 15 years, we don't have the time period actually.
But a fair assessment as well. So, in some sense, a fairly realistic answer. And I hope, Prasanna, that you assess Prableen's response to the investment patterns that you currently have and change them in some fashion, as Prableen has advised, so that you can reach your goal in a more effective fashion. Prableen, on that note, we're out of time, but thank you so much for taking the time out and being with us on the Mutual Fund Show. Really appreciate your time.
Thanks, Neeraj. My pleasure.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.